Welcome to Investing Insights. I'm your host, Ivana Hampton. There's a tug-of-war between investing in cash and long-duration bonds in today's interest rate environment. The longer end of the yield curve may look more appealing since anticipation is building about interest rate cuts. Morningstar's economics team and market watchers are predicting the Federal Reserve will lower rates more than once in the final months of 2025. What may matter more is the time horizon for your financial goals. Morningstar Inc. portfolio strategist Amy Arnott has examined why, for some investors, sticking with cash is a less risky and better approach. Good to see you, Amy.
Great to see you too.
Let's start with an explainer. What is cash? Because it's more than just the dollar bills in our wallet, right?
Right. And I don't know about you, but I hardly ever have cash in my wallet these days.
I struggle with that.
So cash could be any type of asset that is very safe, liquid, and short-term. So it could be something like a money market fund, a savings account. I think we'll talk about some of the other options later. But the official definition is a cash has a maturity date of 3 months or less. So it's very short term. It's not really going to be affected by changes in interest rates in terms of price movements.
Interest rates are a popular topic right now. The Federal Reserve is scheduled to announce their interest rate decision this afternoon. Morningstar economics team and market watchers are predicting lower rates. Should bond investors swap out Treasury bills that are short term for 20 to 30-year Treasury bonds? Before you answer that, let's timestamp this moment. It's around 10:30 a.m., Wednesday, September 17th.
Yeah, so we'll know more this afternoon when the announcement comes out about interest rates, but almost everyone at this point is expecting the Fed to make some type of cut later today, so either 25 basis points or possibly even 50 basis points. So if you're a person who's expecting rate cuts to continue, you might be tempted to buy longer duration bonds because you could get some price gains as rates come down. Those bonds become more valuable. But on the other hand, you would also be taking a lot more risk. So especially if you're on the very far end of the yield curve, if you have a situation where rates are going in the opposite direction, you can have pretty big losses. And, I think a lot of people are still really scarred by 2022 when we had double-digit losses in the bond market. And especially if you're in a really long duration bond, let's say a fund like iShares TLT, which focuses on Treasury bonds with 20-year maturities or more, that fund was down about 31%. So, the key trade-off is possibly bigger gains if interest rates are decreasing, but also potential for losses if rates are increasing.
Talk about why it could be a mistake for bond investors to assume that the Fed will cut rates to match predictions.
Yeah, so predictions are very hard. And, even when there seems to be a really strong consensus in the market about what's going to happen, that consensus isn't always right. And we saw that, I think, heading into 2024, when institutional investors were expecting rates to come down. At one point, people were expecting as many as 7 rate cuts during the year, with total cuts of, up to 175 basis points. And that really didn't materialize. So, we ended up with only 3 cuts during the year. So the danger is it's hard to predict things. And if you do get it wrong, it can end up hurting your results.
In your article, Why Cash is Still King for Short-Term Goals, you described a couple of reasons why cash yields still look good. Can you explain?
Yeah. So one thing I would point to is the difference between the yields you can get on the very long end of the yield curve versus the short end. And as you can see in the graphic, right now, if you're on the shortest end of the yield curve in cash or cash-like assets, you can get a yield of about 4.2 2% or a little bit more than 4%. If you go out into the middle of the yield curve, there's kind of this V shape right now where the yields actually go down. So you're getting less yield. And then as you go out to the long end of the yield curve, you might be able to get 4.6 or 4.65%. So you're still getting more yield on the very long end, but that gap between the short and long end of the yield curve is smaller than it's been historically. So you're not getting as much of a yield bump by taking on additional interest rate risk. The other thing that I would point to is if you're holding cash, you're still able to keep ahead of inflation. So, the most recent inflation number was 2.9%, but cash yields are still higher than that. So if you're holding cash, you're not losing value because of inflation.
And what are some of the trade-offs when holding cash?
Yeah, so on the positive side, you can get high level of safety, liquidity if you need to use those assets for an emergency or if saving for a short-term goal. On the negative side, cash really isn't a growth asset. So if you're saving for a long-term goal, something like retirement, or you want to leave behind a legacy for your children or charity, cash isn't the best place to build long-term wealth.
Where are the best places to invest cash if you need the money within the next 12 months?
Yeah, so I would point to 3 different options. One would be a money market fund, which is, it's a type of mutual fund where it's safe, it's very highly liquid. You can usually it usually integrates very well with your checking account and it's easy to move money around. Another option would be a certificate of deposit where you could, you may be locking up your money for a certain period of time, like 6 to 12 months, but you get a guaranteed interest rate during that period of time. And another good option could be buying Treasury bills directly from the US government. So you could go to treasury.gov and actually purchase Treasury bills there.
Are there any places where people may not want to keep their cash holdings?
Yeah, a lot of people like to keep cash at home because they feel like it's safe. It's going to be there whenever they need it. If there's some sort of natural disaster or other emergency, the downside with that is obviously there's a risk of theft, and also you might forget where you have that cash stashed away in the basement or the attic. Another option that I wouldn't recommend would be a bank savings account. In most cases, if you go to your local bricks and mortar bank, the interest rate that you can get on a savings account is very, very low. And then the other thing that I would avoid would be what's called a sweep account. If you have a brokerage account and you sell a stock or a fund, or you have dividends that you're not reinvesting, those will normally go into a sweep account, which also tends to have very low yields. So if you do have assets in a sweep account, I would try to transfer it out as soon as possible.
And what about goals that have a time horizon that's a little bit longer, like 2 or 3 years?
In that case, you could look at something like a short-term bond fund or ultra-short bond fund. These are funds that don't have too much interest rate risk and usually have relatively high credit quality. You could also look at a CD that has a maturity date that lines up with when you want to use those funds. Or you could look at a defined maturity bond fund that has a maturity date that lines up with when you might need access to that cash.
And what's the takeaway for investors weighing whether they want to take on the risk of long duration bonds?
Yeah, so I think, everybody likes to talk about what the Fed is going to do. Will they cut rates? How big will the rate cuts be? But I think really the most important thing is to stay focused on your own goals and your own time horizon. And that should really determine if it makes sense to keep assets in cash or other types of securities.
So you heard it from Amy. Stay focused on your goals and your time horizon. Amy, thank you for coming to the table.
Great to be here. Thanks for having me.
We're introducing a new segment on investing insights. The Market Brief series on Morningstar.com focuses on the biggest headlines with insights from Dan Kemp. Did you read it this week? It's worth your while. Dan is the Chief Research and Investment Officer at Morningstar Investment Management Europe. Dan will be sharing his perspective on this podcast, along with a preview of the following week's column. Welcome to Investing Insights, Dan Kemp.
Ivana, it is fantastic to be with you. Thank you so much for having me on.
I am so excited because you're based in London, but you're in Chicago, so we get to talk in person. Can you tell the audience a bit about what you do here at Morningstar?
Yeah, sure. Absolutely. So it is great to be here in person here in HQ in beautiful Chicago. So so I'm privileged to lead a team of about 350 analysts and investment managers, and we produce independent research on strategies, the medalist rating that Morningstar is so familiar with, but also equities and asset classes, and run just over $300 billion in assets within the investment teams in Morningstar. So I just have the best job in the world.
You do. Well, mine is also great. So you write the weekly Markets Brief column that publishes on Morningstar.com on Mondays. Talk about why it's a must read.
Yeah, sure. Well, listen, I've been doing this for almost 30 years. And the main thing I've discovered over that time is that there's an enormous amount of noise in the market that we're bombarded with all the time. And it's very difficult to pass out that noise from the genuine signal, information, insights that you need to make good investment decisions. And so the Markets Brief does that. I look at what's going on in markets, what's happening in economics, what's coming from our research teams, and try and draw out that signal from the noise, help people make better decisions, help people get to their financial goals, empower investor success.
Love it. So let's talk about this week's article. You wrote about Oracle's phenomenal growth due to the surging AI demand for its cloud services. What's the big takeaway for investors?
Well, you're right. It was a huge story. Oracle shocked the market with all of these massive orders that have come through as they transition from being a sort of database provider that we're all familiar with to being a cloud operator. And it's really transforming that business. And so as we look at the orders that are coming, as you said, primarily from AI, there's really two big takeaways. The first is that movement in a single stock in such a concentrated market that we're living with these days can have a big impact. And so when you look at the 42% rise that Oracle experienced on this news, that moved the whole US technology sector about 2.8% last week, which added almost 1% to the returns of the main US index. That's an enormous impact. And what that really says to an investor is that if you're comparing your performance against a benchmark or other peers, then at the moment, what you don't own in a portfolio is almost as important, sometimes even more important than what you do own, because this small number of stocks, particularly those in technology and AI, are really driving the market. So you have to pay attention to what you don't own. And again, by talking about Oracle, we're trying to bring out the impact there. And then the second thing is that with a stock like Oracle, it's really been in the back of most investors' minds for a while. When we think about AI, the revolution is happening there, and cloud and everything that's going on, we tend to think about the so-called hyperscalers that are really dominating the headlines. But actually, it's other stocks in that market that are making good use of AI, that are serving that environment, that really there are some big gains, some big opportunities there. And so if you compare the price of Oracle this year to NVIDIA, guess what? Oracle's done twice as well. Now, a lot of that was in the last week, but we talk about NVIDIA all the time, but actually Oracle has been the big performer of those two.
Oh, wow. So what are you keeping your eye on for next week?
Well, it's all happening. It's mainly happening at the Federal Reserve. The FOMC, of course, releases their next interest rate announcement on Wednesday this week. That means the back part of the week is going to be dominated by the impacts from that announcement. And so I'm spending my time thinking about how that announcement feeds through into changed opportunities and risks in the broader markets. The announcement itself is fairly unimportant, but the impacts it has can make a huge difference to investors, not just over the next kind of days, weeks, or months, but much further into the future.
And I always let our audience know we're recording this on Tuesday, September 16th, just before 12:30 p.m. How should investors think about it? You're thinking about it. How should we think about it?
Well, you're right. So we're not going to predict what's going to happen, but really the way investors should be thinking about it is that the outcome is reasonably predictable. It may not be exactly what everyone's expecting, but it's going to be somewhere around there. It's very likely to be a cut, and so that's really baked in. The question is, what does that do to longer term asset prices? So let's think about what it's doing to longer-term government bonds. Are they reacting? Is the US dollar reacting? We know that the dollar's fallen sharply over the year to date. That's boosted returns for those that are diversified, that are investing overseas. But does that continue? Do people start changing their perspective of the dollar as the composition of the Fed changes, the direction of the Fed changes? So really, as investors, dig a little deeper. We've got tons of great research on .com from you and from others, where people can really understand what's going on in those broader markets. But whenever you get a big announcement, all of the interesting stuff isn't normally in the announcement. It's how it impacts those other markets. So that's where we should be looking.
Well, everyone listening, watching, if that wasn't a reason to read Dan Kemp's Markets Brief this Monday on Morningstar.com, I don't know what else we can say. Thank you, Dan, for coming to the table.
Well, thank you so much for inviting me.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you. And subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to Senior Video Producer Jake Van Kersen and Associate Multimedia Editor Jessica Bevel. I'm Ivana Hampton, Lead Multimedia Editor at Morningstar. Take care.